Welcome to The Explainer. Today, we're going to tackle one of the most popular and honestly one of the most misunderstood concepts in investing, dividends. I mean, the world's first billionaire, he definitely got it. And for good reason, right? Dividends can be an absolutely massive tool for building wealth. Just how big? Well, get this. Over some 20-year stretches, dividends have made up a jaw-dropping 60% of the S&P 500's total return. I mean, think about that for a second. That is a huge piece of the pie, coming straight from these cash payouts. But, and this is a big but, chasing those dividends isn't always so straightforward. So that's what we're going to do today. We're going to dive into what makes them so powerful, but also shine a light on the hidden dangers that can trip you up. Okay, so first things first. Let's talk about the good stuff. What's the big deal with dividends anyway? Why do investors get so excited about them? Well, it's actually pretty simple. You know, when a big established company makes a ton of profit and runs out of smart ways to reinvest all that cash back into the business, what do? Well, they give some of it back to you, the shareholder. Think of it like a thank you note, but made of cash. And yeah, the benefits are pretty tempting. You get this nice, steady stream of cash coming in, so you don't have to sell your shares just to get some spending money. A lot of people also see dividend-paying companies as being, safer and more disciplined. And hey, in some places, you even get a better tax deal on that income. It's real money, right in your pocket. But maybe the biggest reason of all, the real secret sauce, is something called the compounding snowball effect. Seriously, this is where the magic really starts to happen. So, let's break it down. Imagine you've got 20 shares of a company, and boom, they send you a $20 dividend. Now, instead of going out and spending it, you take that cash and buy one more share. Pretty straightforward, right? Okay, now fast forward. If you just keep doing that for 10 years, suddenly you own 33 shares, and you haven't put a single extra penny of your own money in. And because you own more shares, your annual dividend income is now bigger. It's this beautiful, perfect little cycle. More shares get you more dividends, which get you guessed it, more shares. But hold on, because it gets even better. What happens if the company itself starts getting more generous and actually increases the dividend it pays out each year? That's what we call dividend growth. All of a sudden, that snowball isn't just rolling downhill, it's picking up speed like an avalanche. Your annual income practically doubles. Why? Because not only do you own more shares, but now every single one of those shares is paying you more money. This right here is how real wealth starts to multiply. Okay, so at this point, you're probably thinking, this is awesome. All I need to do is find the stocks with the highest possible dividend yields, kick back, and get rich. Sounds easy, right? Well, not so fast. This is exactly where we run into the dark side of dividends. That super high yield you're chasing, it might just be a trap. You see, a high yield can actually be a huge red flag. Just think about the math for a second. The yield is just the dividend amount divided by the stock price. So what's the quickest way for that percentage to go way up? It's not the company paying out more cash. Nope. It's the stock price crashing. And why would the price crash? Usually because investors are getting really nervous about the company's future. So here's the bottom line. You might think you're getting a great deal with that big, juicy dividend yield, but what you're really doing is buying into a company that's in serious trouble. You're basically trying to catch a falling knife, and we all know how that usually ends. And that brings us to the absolute worst-case scenario for any dividend investor, the dreaded dividend cut. It is a brutal 1-2 punch to your portfolio. And this is where it really hurts. First, bam. That reliable income you were counting on, it either gets slashed or it's gone completely. Then, pow! The stock price tanks because that dividend cut is basically the company screaming to the world, yup, all your fears were right, we are in big trouble. And hey, this isn't just some textbook theory. Just look at what happened with a giant like General Electric. When they announced they were cutting their dividend back in 2017, the stock got hammered. Just like that, investors lost their income stream and watched the value of their shares just plummet. So, the big question is, how do you get all the good stuff from dividends without falling into these traps? Well, that's what we're going to cover right now. How to build a smarter approach that's about way more than just chasing a high number. So instead of getting mesmerized by a high yield percentage, you've got to shift your focus to quality. That's the real game changer here. You're not just a yield hunter, you want to be an investor in dividend growth. That means looking for companies with a long, proven history of paying their dividend, and even better, consistently increasing it through thick and thin. And probably the most critical tool in your toolbox for this is something called the payout ratio. It's a really simple number that tells you exactly what percentage of a company's profits are being paid out as dividends. It answers the single most important question: is this dividend actually sustainable? Think about it, right? If a company is paying out, say, 40% of its profits, that feels pretty safe. They've got a lot of room to breathe. But if you see that number creeping up over time to 60%, 80%, or holy cow, over 100%, that means they're paying out more than they're earning. That is a massive, flashing, red light warning sign that a dividend cut is probably coming. So are dividends a reward or a warning sign? Well, the truth is they can be both. And the final takeaway is that you can never, ever just look at the yield number. The real story, the answer to whether you found a healthy reward or a dangerous trap, is always hidden in the details. You've got to look at the company's history, its financial strength, and most of all, its ability to keep that cash flowing, not just today, but for years to come.